Many studies have proven that journaling is an important thing to do. It clears our head, it clarifies our thoughts, it helps to track our growth and pause and reflect on our actions and set future goals. But why do I talk about journaling in a business context? Well, business also do some kind of journaling, some form of journaling, and at the end of the process they come up with something called the financial statements. So you can consider financial statements as a form of a report card or a progress card for the business, like how they performed during that period and what are the key areas they are looking into and where should they aim to. Welcome back to another video from this YouTube channel, Accounting Nerd. In this video today we are going to talk about one of the critical areas of accounting, which is called the financial statements. Let's jump right in. Let's start with the story. Gabriel, who is running a restaurant's business. Like I mentioned before, everything in a business has to be journalized on a daily basis, based on a day-to-day activity basis. Whatever things which are there in the business can be classified into four main elements for which we can use the acronym REAL, R-E-A-L, revenue, expense, assets and liabilities. Anything and everything in a business falls under either of these four categories. Let's explore each of them. Revenue. Revenue is the money received from the customers. In the case of Gabriel, when the customer comes to the restaurant and have their food, when they pays the money, this can be considered as the revenue for Gabriel's restaurant. And when it comes to expenses, these are the cost incurred to operate this business. For example, the cost incurred to buy the groceries, the cost incurred for the electricity bills or water bills, things like that. And assets which are owned by the business. For example, if the land and the building in which the restaurant operates are owned by the Gabriel's business, it can be considered as an asset. It will be classified as an asset in the financial statement. And also the tables, chairs, the cooking facilities, arrangements and everything can be classified as assets in the financial statements of Gabriel's business. And finally, the liability. This is something that the business owes to others. For example, a business loan that has been taken to start the business. It is considered as a loan and categorized as a loan in the financial statement. There's one more thing. For example, if Gabriel has invested some money into the business, this will also be considered as a liability from the point of view of the business. But this will be very different from what an external liability is. Even though this is also considered as a kind of a liability, in the financial statement, this will be split into a different section, which I'll cover when we come to that part. So the four elements is being described: real, revenue, expense, assets and liabilities. But all these four items are not simply put together into a single financial statement. These are divided into two major financial statements, which are called the statement of profit or loss, also known as the income statement, and the statement of financial position, also known as the balance sheet. There is one more major financial statement, which is called a statement of cash flows. So as the name suggests, it simply records the flow of the cash, how cash comes into the business and how cash goes out of the business. So let's look into each of these financial statements in detail. Statement of profit or loss or income statement. It can be considered as a video recording of your business. For example, if you start recording at the beginning of the year and keep on recording the video till the end of the year, this is simply called the statement of profit or loss. That means whatever transactions that has been taken place in the business for that particular period is recorded in the income statement. So out of the four elements that we have discussed, revenue, expense, assets and liabilities, revenue and expenses will be going to the statement of profit or loss or income statement. Now, this income statement would be for a selected period of time. This is called the accounting period. This accounting period is generally 12 months, but it can be less than or greater than 12 months. There are certain situations where the financial statements are prepared for less than 12 months or greater than 12 months. In a general scenario, it will be considered as a 12 months period. For our example as well, we'll be using accounting period as a 12 months period starting from 1st of January 2023 to 31st of December 2023. I'm taking you through a basic income statement prepared for the Gabriel's restaurant. First thing you'll notice is the name of the business, which is Gabriel's restaurant, and the name of the statement here, statement of profit or loss, and the accounting period for which the profit or loss account has been prepared for. In this case, This is for the year ended December 31st, 2023, which means this income statement includes every transaction that has been occurred in the business from 1st of January 2023 to 31st of December 2023. And if you go down, you can see the main two heads, revenue and cost of sales. There are multiple other heads as well, which we'll explain in detail. The first thing, revenue. Sales revenue, that's foods and beverage. So these are the main revenue Gabriel's restaurant has earned by selling food and beverage. And right below that you can see event space rental and catering services, which is also one of the key operational revenue for Gabriel. So from that we are concluding the total income for that particular period. The next line is cost of sales. That means the cost incurred to make the sale happen. Food and beverage cost, it includes the grocery or the ingredients cost, kitchen supplies, any other utensils or some kind of one-time usable items that are used to prepare these items, which takes us into the total cost of sales. And we come into something called gross profit, which is the total revenue minus the total cost of sales. And below that we have few other items, other income and other expenses. We'll explain these details in another video where we will be looking solely into a single financial statement. So this video is aiming at providing you a basic understanding of which all financial statements are there and what are the major contents of the financial statements. So at the end of the income statement, you can see the profit for the year, which simply means the revenue minus the cost of sales. So if it's a negative, which means Gabriel has incurred a loss, and if it's positive, which means Gabriel has earned profit. So that takes us to the next important financial statement, which is called the balance sheet or statement of financial position. A balance sheet, when I told you that income statement is like a video recording of all the transactions in the business for a particular period of time, balance sheet is like a snapshot of the balances of the business at the end of the accounting period. In our case, 31st of December 2023. If you take a photo of the business at the end of the accounting period, the 31st of December 2023, whatever that's there in the business, whatever assets they own and whatever liabilities the business owes to others, everything will be recorded in this financial statement. Do you remember the four elements that we have discussed at the beginning of the video? The revenue, expense, assets and liabilities. So the revenue and expense has gone to the income statement. So the remaining things are assets and liabilities. And this will be going to the statement of financial position or a balance sheet. Assets are something that's been owned by the business and liabilities which are owed by the business to others. So when the assets and liabilities comes to the statement of financial position or the balance sheet, the liability gets split into two different items. One, equity, and the second one, liabilities. The equity refers to anything that is payable to the owners of the business. From an accounting point of view, the owner and the business are two different entities. This is called separate legal entity concept. If you want to know more about the different types of businesses, and I have already made a video on that, you can refer to that. I'm just going to take you through a demo balance sheet of Gabriel's business. If you look at the top of the statement, you can see that the name of the business, just like what we saw in the income statement, and right below that we have the name of the statement, which is statement of financial position, and also the date as of December 31st, 2023. If you have noticed something, you can see that in the income statement, it was mentioned as for the year ended, which means, as we discussed, that statement is for that specific accounting period. But if you look at the balance sheet, it is mentioned as of December. That means at that point in time what all things are there in the business. So if we go down, we can see assets. We can see a furthermore classification like the non-current assets and current assets. The non-current assets are those which last for more than 12 months period. So if you see here, the first thing, property, plant and equipment, which normally includes the land in which the Gabriel's restaurant is situated in and the building in which the restaurant is running in. So these two are items that last for more than 12 months period of time. So that's why it's categorized as a non-current asset. Then you can see the furniture and fixtures like the tables and chairs and everything. Then the kitchen equipment like the utensils, which can be used for more than 12 months. And if you go further below, you can see the current assets. We have the cash and cash equivalents. As of now, we can consider it as just cash in the till. And the accounts receivables, any customers which are on credit. For example, some customers came into Gabriel's restaurant, had their food and they have not yet paid the amount. From the point of view of Gabriel's business, this is an asset. Gabriel business is about to receive that money from the customers, which is categorized as an account receivable. Inventory. These are inventory for the foods and beverages. The groceries and ingredients, all of them comes under the inventory section. And if you look at here, we have the total of the assets, which is the total of the non-current assets and the total of current assets. And if you go further below, you can see the equity and liabilities. First thing shown is the equity. You can see something called share capital, which is the amount invested by, which probably could be the amount invested by the Gabriel. And retained earning, if you see that, so considering that this is the first year of operation, this retained earning would be equal to whatever we have in the income statement. We'll be having a follow-up video on this, like we'll be explaining each of the financial statements in detail and how to prepare them. So in that video, I'll be explaining how the balances from the P&L account is flowing to the balance sheet. And if you go further down, we can see that liabilities. Liabilities are also further divided into two parts, non-current liabilities and current liabilities. We have a long-term loan which lasts for more than 12 months. And we have accounts payable, which is any money payable to the suppliers or any short-term payable that Gabriel's business has to pay within 12 months of period, which comes to total equity and liabilities. And if you have noticed something, the total assets are equal to total equity and liabilities. So this is one of the key formula in accounting. The total assets of a business should be equal to the total equity and liabilities of that business. We'll be having another video explaining this formula in detail. So with that being done, I'll also take you through the statement of cash flow as well, which would be an alienated thing for us for the moment. We won't be looking into that in detail now, but I'll just show you how it looks like. This shows the overall flow of cash, the inflow and outflow of cash. Okay, now you may ask how this is being prepared. We actually have a set of rules, like how it should be prepared and how it should be presented. In all over the world, we have accounting bodies like the IASB, International Accounting Standards Board, and their set of rules like the International Financial Reporting Standards, IFRS. Using that particular rules and principles, the businesses will be preparing the financial statements because it increases the comparability. For example, if you have to compare the Gabriel's business with some other major restaurant, you can do that only if both the financial statements are in the same format or both of them are prepared using the same rules and regulations. So we have a set of accounting standards which we use to prepare these financial statements. And who are using these financial statements? Like I mentioned before, financial statements are something that records all the past information, like whatever the business has incurred, and it gives us a proper look into what all things that has happened in the business over a period of time. There are multiple users, we can call them stakeholders of the business, who uses these financial statements. For example, investors. Those people who are interested to invest their money into a business, they have to see how the business is being performing for the past few years. So they can look into that details using the financial statements. The suppliers are interested in this because they are supplying goods to the businesses. They have to make sure that the customer base is rigid. They will have this customer for a prolonged period of time. And if the supplier is giving the materials in credit, the supplier has to make sure that the buyer or the business has the ability to pay back. The third would be the customers. Why the customers? Because for the same reason as suppliers, customers also have to make sure that they'll be getting whatever things that are being supplied by the business for a prolonged period of time. The government. Why the government is interested? Government has to set policies, measures and everything, and also government has to impose some taxes on the activities of the businesses. For all of these activities, a proper financial statement should be in place. And more importantly, the lenders, for example, a bank which is going to issue a loan to business, the bank has to analyze the position of the business at that particular period and how it performed for the previous periods, because only then the bank will be able to identify whether the business will be able to repay the loan or not. So for these purposes, there are multiple stakeholders who are interested in a business to use the financial statements at different levels for different purposes. So with that, we have reached the end of this video. If you have stayed till the end of this video, thank you so much for that. And with this video, we are starting a new series called the Fundamentals of Accounting, in which we'll be describing how the accounting is done and what are journal entries and how it is being formed to a financial. So stay tuned for that, and till we see again, bye.